Imagine waking up, checking your phone, and going through your bank account as usual. At first, everything seems normal. Your balance is there, your deposits have been made. Nothing seems out of place, but behind the scenes, something has changed, and most people have no idea what's going on. Because from 2026 onwards, a single number, 10,000, could silently determine whether your financial activity is flagged, reviewed, or questioned. And here's the part that's catching so many people off guard. It's no longer just about large transactions, it's about patterns, opportunity, and how your money moves. Even if every dollar in Acer is suspicious to a system that doesn't know them, is unaware of their history, and doesn't care about their intentions. And once they are in the spotlight, the consequences can range from a simple letter to something much more damaging. So the real question is, what really changed, and why are so many older adults at risk without even realizing it? In this video, we'll take a detailed look at what the $10,000 rule really means heading into 2026, what's changing behind the scenes, and why it's affecting older adults more than almost any other group right now. We'll explain it clearly and practically, without jargon or alarmist tactics, just what you need to know to protect yourself and stay in control of your finances. We will address real-life situations that seem completely normal on the surface, but which can generate concern under the current system. Most importantly, what simple steps can you take to avoid problems before they arise? Because once you understand how it works, the whole situation will be much more manageable. Before continuing with this video, please take a moment to subscribe to the United States Immigration Guide and help us reach our community of 10,000 subscribers. Don't forget to like and share this video so that this important information reaches others who need it. And if you have any questions, leave them in the comments below. I personally read them and respond with the best guidance possible. To illustrate, let's talk about Patricia. She is 71 years old. She is a retired teacher who dedicated more than 3 decades to teaching. She leads a quiet and organized life and, like many retirees, manages her finances carefully. Each month, he receives his Social Security check. From time to time, he transfers money from his savings to cover major expenses, a medical bill, a home repair, a visit to his grandchildren. Nothing out of the ordinary, nothing risky, simply the financial routine that millions of seniors follow daily. He has never tried to hide money, never evaded taxes, never done anything remotely questionable. But with the systems being used and expanded in the lead up to 2026, Patricia's perfectly normal behavior could start to look unusual, not to a person, but to an automated system trained to detect patterns, because the system doesn't see a retired teacher managing her savings. View deposits, transfers, schedules, and amounts. And if those patterns don't clearly match what's recorded on paper, they may raise a red flag. To understand why Patricia and millions of people like her could end up in the crosshairs, we need to understand the origin of this entire system. It all goes back to 1970 when the United States enacted the Bank Secrecy Law. At that time, the objective was, of course, to provide the government with a way to track serious financial crimes such as money laundering, drug trafficking, and tax evasion. As part of that law, banks were required to report certain types of transactions, specifically any cash deposit or withdrawal of $10 or more. That report is called a cash transaction report, and for decades, that $10 threshold has remained unchanged. But what many people don't know is that this figure was established more than 50 years ago. Adjusted for inflation, 10 oro back then would be roughly equivalent to 80 pesos today. In other words, what was once considered a large and unusual transaction is now much more common in everyday financial life. Retirement distributions, housing-related expenses, and even certain types of savings transfers can easily reach that level without raising any real concerns. But the system was never adjusted. The figure remained frozen in time. This raises an important question. If the rule itself hasn't changed, why does the risk suddenly seem to be increasing? The answer begins with something most people don't even know about: structuring. In theory, the structuring is quite simple. It consists of intentionally dividing a large transaction into smaller amounts to avoid the requirement to declare the $10,000. For example, instead of depositing $15,000 all at once, someone could deposit $9,000 today, another $9,000 tomorrow, and keep it all just below the threshold. That pattern, even if each individual deposit is less than $10,000, is considered a red flag and in serious cases can even be treated as a federal crime. The idea is to catch people who deliberately try to hide money, but this is where things get complicated. The system doesn't know the intent, it doesn't know why those deposits were made, it only sees the pattern. And that's precisely where older people, more than almost any other group, begin to run into problems without realizing it. Many older Americans didn't grow up in a world of digital banking and automated tracking. Many still prefer cash. Some people keep money at home. Others make smaller, more frequent deposits simply because that's how they've always managed their finances. It feels safer, more controlled, more familiar. But to an automated monitoring system, that same behavior can look almost identical to that of someone trying to circumvent reporting rules. There have been real cases where law-abiding individuals had their accounts flagged simply because their deposit habits did not conform to what the system expected. No criminal intent, no hidden income, just a discrepancy between human behavior and the machine's interpretation. And once that alert is triggered, it can set off a chain reaction for which most people are unprepared. In some cases, the situation worsens. Accounts may be reviewed more closely, transactions questioned, and in more serious situations, especially when manipulation is suspected, funds may be frozen while an investigation is conducted. There are documented cases where people had tens of thousands of dollars blocked for months, sometimes even longer, simply because their transaction patterns raised suspicions. What further complicates the situation is how the process works once this happens. In certain cases, the responsibility to prove the legitimacy of your money falls on you, not the other way around. This involves gathering records, explaining transactions, and sometimes even hiring legal counsel to regain access to funds that originally belonged to them. For someone with a fixed income, this type of disruption is not only an inconvenience, but can be financially devastating. Now, to be clear, this is not what happens to most people. Millions of transactions are reported every year, and the vast majority are never followed up on. But the reason this matters, especially now, is because the system that decides which cases receive attention is changing. And that's the point that leads us directly to what will happen in 2026. Because the most important change is not the $10,000 rule itself, but how it is being applied. For decades, these reports remained in massive databases with a limited capacity to analyze them meaningfully and in real time. But that is no longer the case. IRS now has much more funding, more advanced systems, and far more sophisticated tools designed to analyze financial data on a large scale. What previously required manual review can now be done automatically. Patterns can be detected instantly. Transactions can be compared against your declared income, tax returns, and financial history without any human review beforehand. The rule did not change, but its application did. This affects everyone to some extent, but older people are in a particularly vulnerable position within this system. And the reason lies in how retirement finances actually work in real life compared to what they're written on paper. During your working years, income tends to be predictable. You receive a paycheck, taxes are withheld, everything is relatively straightforward. But in retirement, that structure changes completely. Income begins to come from multiple sources: Social Security, pensions, retirement accounts, savings, and it doesn't always follow a clear and consistent pattern. One month might be quiet, the next might include a larger withdrawal, a transfer, or a single deposit. That makes perfect sense to you, but for an automated system that seeks consistency, those variations can stand out. Let's take retirement distributions as an example. If you withdraw money from an IRA or a 401k, especially for mandatory minimum distributions, those amounts can easily exceed $10,000 depending on the size of your savings. That transaction is reported, and if your tax return doesn't clearly reflect or explain that money movement in a way that the system can quickly verify, it can raise questions. There are four crucial situations: the precise moments when completely normal financial behavior can begin to look suspicious. The first are retirement distributions. If a distribution exceeds certain thresholds, especially if it is around or above 10,000, it must be declared. And if the timing or amount does not clearly match what is reflected in your tax return, even temporarily, it may raise suspicions. The second is donating money to family members, helping children, supporting grandchildren, contributing to important life events like education or buying a home. In most cases, this is perfectly legal. But large transfers, repeated transfers, or cash donations can create patterns that appear unusual if they are not clearly documented. The third are major life transitions, such as selling a home or receiving an inheritance. These are significant financial moments that often involve large sums of money, which can create temporary spikes in your financial activity that stand out markedly compared to your usual patterns. The fourth practice, and the one that often goes unnoticed, is cash based habits or informal financial arrangements. Things like selling personal items, collecting rent, or temporarily holding money for a family member and then transferring it. These situations usually involve cash or several small transactions. And when these transactions begin to form patterns that resemble financial structures, they can generate concern. Once a suspicious transaction or pattern is detected, it doesn't automatically mean there's a problem, but it does mean that the information is entered into a system designed to examine it more closely. When a bank files a report, that information is sent to a federal database managed by the Treasury Department. From there, it becomes accessible to agencies like IRS. In many cases, nothing happens. But if something stands out, if there's a discrepancy, a pattern, or a question that can't be easily answered, then you can move on to the next step. You could start with a letter requesting clarification. In other cases, it can escalate to a formal audit. And in more serious situations, particularly when the patterns resemble unexplained structuring or cash flow, accounts may be restricted, funds may be temporarily frozen, and in rare but very real cases, legal proceedings may be initiated that require you to actively demonstrate the origin of your money and why it was moved in that way. Here comes the part that's almost never explained, but which completely changes the perspective. The vast majority of these reports never lead to anything. Millions and millions of transactions are flagged, recorded, and stored every year. Most are never reviewed by a person, but the system is improving its ability to better focus the information. With more advanced tools, better data comparison, and automated analysis, you only need to identify the most relevant patterns. The risk, while still relatively low at the individual level, is becoming more specific, more selective, and more dependent on whether the financial activity is easy to understand or confusing when analyzed solely through data. Therefore, the real goal is not to avoid the system altogether. The goal is to ensure that if the financial activity is ever reviewed, it makes sense immediately without guesswork, ambiguity, questions, or answers. There are some simple and practical steps that make a big difference. The first and most important is to keep clear and organized records of your financial activity, not only your monthly statements, but everything related to major or less frequent transactions. If you sell your house, keep the closing documents. If you receive an inheritance, keep the documentation. If you make a withdrawal from a retirement account, keep the account statements that explain it. And if you give money to a family member, write it down. Date, amount, and purpose. The system can flag a transaction, but it can't dispute a clear written record. The second step is to work with the right kind of professional. A qualified tax advisor who understands retirement income, withdrawals, and reporting requirements can help you structure things in a way that is both compliant with the law and easy to explain. The third step may seem counterintuitive, but it is fundamental. Avoid trying to go unnoticed by splitting transactions. If you need to transfer a large amount of money, do so clearly in a single transaction and document it properly, as several small deposits totaling just under 10,000 can look much more suspicious than a single larger deposit that is clearly explained. If you receive a letter or notification, the worst thing you can do is panic or ignore it. You have the right to understand why you are being contacted, to respond with the relevant documentation, and to have legal representation. A qualified tax advisor or lawyer can step in, communicate on your behalf, and ensure that everything is handled correctly. In many cases, what initially seems serious can be resolved with clear records and a simple explanation. Another important step, especially for older people, is to ensure that financial support between family members is managed in a way that is easy to track and explain. Perhaps an adult child will help cover expenses by depositing money into his account. Perhaps you help a grandchild and send them funds regularly. From the system's perspective, repeated cash deposits or inconsistent amounts can begin to generate patterns that don't immediately make sense. The best way to manage this is to use methods that leave a record, such as checks or electronic transfers, and keep a record of the reason for those transfers. And if you're helping a parent or relative manage their finances, make sure everything is properly set up with legal authorization, such as a power of attorney, so there's no question about who's managing the account and why. One of the most overlooked risks in all of this isn't directly related to the IRS, but it can get you into the same kind of trouble: financial scams. There are criminals who specifically target elderly people with instructions that seem simple, urgent, and strangely specific. They might ask you to withdraw cash, transfer money in small amounts, or send funds in a way that goes unnoticed, creating a sense of pressure related to a supposed family emergency, legal problem, or government request. But here's the hidden danger. These same instructions, transfer money in small amounts, act quickly, avoid the usual channels, are what they're supposed to be. They can create patterns that look exactly like structuring or suspicious activity. These scams can not only steal your money, but they can also leave a financial trail that raises suspicions within the system. Therefore, one of the most important habits you can develop is this: whenever you're asked to transfer money in a way that seems unusual, rushed, or secretive, stop. Talk to someone you trust before doing anything. Beyond the rules, reports, and systems, there is a deeper problem that many feel, but do not always express openly. It's about the feeling of being watched, of having your financial life monitored after decades of doing everything right. For many older adults, this feeling is not only frustrating, but it feels personal. They worked, they saved, they followed the rules, and now it seems their normal behavior is viewed with suspicion. This tension is real. On the one hand, there's the need to prevent serious financial crimes. On the other, there's a very human desire for privacy, independence, and control over one's money. Understanding how the system works provides something important: control within it. Because once you know what attracts attention, once you understand how financial activity is interpreted, you're no longer guessing. Informed decisions are made, and that completely transforms the experience, moving from uncertainty to clarity. Looking ahead, what is happening now is not temporary. It is part of a long-term transformation in the functioning of financial systems. The trend towards more data, greater automation, and real-time analysis is not slowing down. On the contrary, it is accelerating. Each year, the technology becomes more advanced, systems become more connected, and the ability to detect patterns becomes more accurate. The habits you're developing now, keeping records, being organized, understanding how your money moves, aren't just useful in the short term. They're becoming essential for managing your finances in the modern world. None of this diminishes your ability to manage your money with confidence and security. The risks we have discussed do not come from doing normal things, but from doing them without clear documentation or without being aware of how they present themselves. You can keep records that tell the whole story. You can work with professionals who make sure everything is in order. You can avoid patterns that create confusion. After all, you've dedicated your life to building what you have. You've earned the right to use it, enjoy it, and share it without unnecessary stress or fear. When you understand the rules, know what to pay attention to, and have a clear plan, you can move forward with confidence, knowing exactly where you stand. Yem.